The $92 level is not just a price, it is a confession of systemic bankruptcy for the Western financial order. If you are only staring at the red pixels on the screen, you are missing the explosion at the heart of the global credit system. The core of this forensic report is that Western vaults are physically empty, and $92 is the last pressure valve holding the paper silver myth together. If the $92 line is crushed by physical atoms, the result will not be volatility, but a total credit meltdown. On the 16th of January, 2026, the screens in Lower Manhattan are not recording trades. They are recording an autopsy of a dying credit system. We must reconstruct this carefully staged crime scene to see the theft occurring behind the algorithmic curtain. The New York spot price today is struggling to hold $90.8. But this is merely a hallucination maintained by computers on the edge of failure. The bullion banks have officially betrayed market reality, using fake numbers to hide the fact that their vaults have been hollowed out. This defense of $92 is the final charge of insolvent banks trying to delay their inevitable liquidation. For the last 72 hours, we have witnessed the most violent fight for physical metal in the history of the market. The intensity of this fight has rendered every technical indicator and expert forecast into worthless scrap paper. Every inch of ground is being fought over at a very specific, very critical line in the sand. That line is $92. If you look at the price action from the 15th of January to the 16th, you do not see a market. You see the disappearing collateral trick. The banks have one goal: to protect a solvency line that they can no longer afford to pay. Let us use a slow-motion replay to watch this digital slaughter of global silver holders. On the morning of the 15th, silver's momentum was like a heavy truck with a stuck accelerator and failed brakes. Physical buyers were performing a final audit on a mountain of fraudulent paper contracts. As news spread that Western silver bars were being drained by the East, the buying turned predatory. The price shattered every logical resistance level, smashing directly into an all-time high of $92.23. The chart sent a terrifying signal. The Western monopoly on silver pricing was melting like a glacier in the sun. In that second, the institutional fire suppression system was triggered, replacing trading with algorithmic violence. In less than 10 minutes, tens of millions of ounces of fake silver contracts were flooded into the Globex system. No rational miner sells their life's work during a vertical rally. These silver bars did not exist in the physical world. This was the bank's printing paper to fill a vacuum of atoms, the dying gasp of a failed establishment. Over 15,000 contracts were conjured out of thin air in 10 minutes, suffocating every buy order on the book. The price collapsed from the peak of $92 down to $86.2 in a vertical waterfall. A $6 gap was manufactured in the blink of an eye to execute every long position in the market. This drop was a digital massacre designed to save the banks from total collapse. Mainstream media immediately pushed the bubble burst narrative, hoping to scare retail holders into a panic. They want you to believe the rally is over, so you will hand over your physical atoms to fill their empty vaults. But the truth is that sovereign players are currently buying silver in the underground market at a 30% premium. The banks are selling rubber checks to buy themselves one more day of survival before the world sees their empty safes. We must solve the mystery. Why do the banks react to $92 like it is the face of death? The answer is not on the ticker, it is in the deep ledger of the bank's insolvency. In this week's options pool, $92 is a massive wall of bets that the banks cannot win. If silver settles above $92, the debt owed by these banks becomes an astronomical sum they cannot pay. The losses would move from the trading desks to the very foundation of the banks, creating a crisis no central bank can print its way out of. So they are tearing down the rafters to keep the fire going in a desperate act of sabotage. They are throwing mountains of paper at the market to stop the gravity of physical atoms from returning. However, the script has been shredded because atoms do not take orders from algorithms. Computers can change the color of pixels, but they cannot change the law of supply and demand. When the price was smashed to $86.2, the expected panic did not happen. Instead, it triggered a massive rebound. Imagine you are in a swimming pool, trying to push an inflated ball to the bottom. The harder you push, the more violently that ball wants to rocket back to the surface. The bank's selling pressure is the trembling hand trying to hold the ball down. The global shortage of silver bars is the buoyancy of that ball, fighting to break free. The moment the selling paused at $86, the accumulated energy exploded like a volcano. Within hours, the price ripped back into the heart of the battlefield with terrifying speed. It crossed $88. It crossed $90. It climbed back to $91.5 before the bankers could breathe. The market refused to accept the fake $86 price. Physical gravity resumed control of the system. Faced with this resilience, the banks executed the double tap on the morning of the 16th. As the price approached the $92 deathline again, a second wave of digital selling was unleashed. This was a psychological demolition attempt designed to make you believe the volatility is permanent. They want you to feel nauseous, to feel the vertigo of watching your balance swing by 10% in a day. They want you to hit the sell button just to escape the digital torture they are projecting. This is a war on your nerves, a desperate attempt to buy a single second of peace at $92. Right now, silver is sitting at $90.8, a dangerous equilibrium on the edge of a cliff. This ping-pong volatility is the visual proof of the war between paper promises and heavy silver bars. On one side is the physical reality, industrial giants who need silver to make solar panels and missiles. They are building a concrete floor of atoms that no fake contract can break. On the other side are the insolvent bankers who can only survive by issuing more bad checks. The $90.8 price level tells us that the bank's magic trick is reaching its limit. In the past, a $6 crash would have broken the market for weeks. Today, it took only hours to recover, meaning the center of gravity has shifted to the east. The speed of the bounce proves that the buyers of atoms far outnumber the sellers of paper. Every fake contract the banks sell at these levels is a debt they will eventually have to settle at much higher prices. The market is a spring compressed to its absolute limit. When paper claims outnumber physical bars by a factor of hundreds, every attempt to suppress the price is an act of self-immolation. Do not be fooled by the flickering on your screen or the red numbers in the headlines. Stay anchored to the flow of metal that the banks cannot control. The war for $92 is the final suicidal charge of a failing Western banking system. They have shown their cards. They have nothing left but lies and waste paper. When you see the waterfall on the chart, remember that it is the sound of the system screaming. They are begging you to hand over your real silver so they can survive one more day of the coming purge. Every trade at $90.8 is a blow to the old rules of the world. The banks have won a few pixels on a screen, but they have lost all their chips in the real world. The drain on the vaults is a structural fracture that cannot be repaired. We must now look away from the fake New York ticker and toward the cold, clinical Shanghai lie detector. There you will see why $86 was not a crash, but the last exit ramp before a new era begins. The New York screens are a theater of the absurd. Shanghai is where the real price is found. When the New York algorithms were smashing the price to $86, the Shanghai Gold Exchange did not move. Shanghai's closing price remained firm at $99.69, essentially $100. This has created a situation that shouldn't exist in any textbook, a $13.49 price gap between East and West. In the world of logistics, a $13 gap is not a spread, it is a death warrant for the COMEX. Silver is a global atom, it does not obey central bank signatures. An ounce of silver in New York and an ounce in Shanghai are the same chemical element. They conduct electricity the same way and hold value the same way. In a real market, the price gap shouldn't be more than $1 to cover shipping and insurance. A $13 gap proves that the Western pricing system has completely detached from reality. New York is screaming in a vacuum, while Shanghai is calmly measuring the true value of the metal. This gap creates a gravitational vacuum that is stronger than any interest rate policy. If you are a global trader like Glencore or a sovereign fund, you are looking at a risk. Free money printer. You buy paper silver in New York for the fake price of $87. You take physical delivery and put that silver bar on a plane to Shanghai. You sell it for $100 and pocket a $13 profit per ounce with zero market risk. This trade is happening as we speak, sucking the Western vaults bone dry. By smashing the paper price to $86, the banks have effectively put the U.S. silver supply on a 30% off clearance sale. This is a geopolitical suicide mission. Washington is talking about securing strategic minerals, while New York banks are subsidizing their export to rivals. Every time they smash the price to save their short positions, they make it easier for China to corner the market. They are burning the rafters of the house to keep their trading desks warm for one more night. Why hasn't the $13 gap closed? Because the West is using soft blockades to stop the flow of silver. They are audits, delays, and a 400% surge in insurance rates for trans-Pacific shipments. This is the final defense. If you can win the math, sabotage the plumbing. But physics always wins, and silver will flow to the highest bidder regardless of the bank's rules. The $13 premium is a dam holding back a flood, and the dam is starting to crumble. China is paying $100 because their demand is inelastic. They need it to survive. They control 80% of the world's solar panels and the core of the EV battery chain. A factory in Shenzhen cannot stop because silver got expensive. Stopping is systemic death. The $13 premium is a security fee. They are paying to ensure their industrial heart keeps beating. They are building a strategic stockpile because they see the end of the dollar system. They are dumping paper debt and buying hard atoms. This creates a floor under the market made of reinforced steel. You cannot scare a buyer who needs the metal to keep the lights on in his factory. The East has locked down the physical assets while the West plays with digital ghosts. Every ounce of silver that lands in Shanghai is an ounce that will never return to the West for paper money. The $13 gap proves that the center of the financial world has moved, even if the media hasn't reported it. Our models show that this gap will close through a violent alignment event. The New York price will eventually have to snap upward to meet the reality of the $100 price in Shanghai. The snapback target is $103. It will happen as a vertical leap that leaves the paper traders behind. While the algorithms in New York paint the tape red, the atoms in Shanghai are writing the new rules. We have looked at the crime scene and the lie detector. Now we must look at the engine of the fraud itself. The selling that dropped the price from $92 to $86 in 10 minutes was not real. Samsung didn't sell their stockpile. The US Mint didn't sell theirs. The industrial world didn't panic. The selling was naked shorting, the act of selling a promise for silver that does not exist. The bullion banks print these digital promises to create the illusion of a glut. For 40 years, this trick was the perfect crime, but today, the beach ball effect has turned the crime into a suicide mission. The banks are trying to hold a ball deep underwater, but the buoyancy of the physical market is too strong. Every time they let go for a second, the ball rockets back to the surface. The banks are fighting the laws of physics, and physics never loses. The double tap smash was an act of terror by banks that are terrified of $92. If the price breaks $92, the banks drown in the losses from their own derivative bets. But the forensic data in the open interest tells a story of failure. Usually when prices crash, open interest drops as people give up. But on the drop to $86, open interest actually rose. This means for every fake contract the banks sold, a physical buyer stood there and swallowed it whole. The banks threw their best punch, and the market didn't blink. It just took the delivery obligation. The banks have sold silver at $86 that they cannot find for less than $120. They are gamblers chasing their losses, digging a hole they can never fill. The V-shaped recoveries are the sound of the old pricing machine breaking into pieces. The establishment is selling digits. The world is buying atoms. Do not be blinded by the red flickering on your phone. The volatility is the death rattle of a rigged system. We are at the final verdict of the war for $92. Thursday, the 16th of January, 2026 is the day the paper tigers ran out of paper. Silver is still standing at $90 despite the most aggressive digital assault in history. The verdict is that $80 is gone forever, and $90 is the new launching pad. We are witnessing an asset phase change, the movement of wealth from credit to atoms in physics. Once a phase change begins, it cannot be reversed. The digital claims you hold are volatile. The atoms you hold are solid. Every $13 premium in Shanghai is a siren telling you to get on the lifeboat. The paper pricing mechanism is failing because it has lost its connection to reality. Silver is no longer a commodity. It is a sovereign strategic asset. It doesn't care about the Federal Reserve or the dollar index anymore. The first rule of survival is that any asset you cannot touch is a liability in a crisis. The street price of silver is already $120, while the screen says $90. You are holding a physical asset that is being discounted by a fraudulent algorithm. Why would you sell a lifeboat at a 30% discount while the ship is sinking? The alignment event will be a vertical jump to $103 to stop the drain on the vaults. This is the rubber band effect, and the snap will be violent. The pricing power has moved to the east, and it is never coming back to New York. You are not betting on a stock. You are betting on the laws of the universe. The banks declared war, but they forgot they cannot print silver. The verdict is final. $92 has been breached in spirit, and $100 is the next stop. The banks have fired their last shot, and we are still standing. Do not let the noise shake you out of your future. The Shanghai price is $100. The street price is $120. The paper price is a lie. Hold fast. Gravity has arrived. Hold your atoms.